Hey everyone, this is Cecilia Williams with eXp Realty.
I'm Nick Gaudet. I'm a financial advisor and a mortgage agent with Virtue Life Financial.
I'm Hannah Martens. I'm a financial advisor and mortgage agent with Virtue Life Financial as well.
So thank you guys for sitting down with me today. I've had a couple of hot topics come up with clients, and so I thought we could talk about it further. First and foremost, the Down Payment Assistance Program. What is it? How does it work?
So the Down Payment Assistance Program is a provincial program where they cover 5% of the down payment in a 10-year term, 5% per year annum loan.
So it's basically almost like a second mortgage.
Yeah, so it's registered as a second mortgage on your property just for that 5%. So the criteria for the Down Payment Assistance Program, pretty much how it starts is you'll fill out a pre-approval with Finance PEI. Once you're pre-approved for that, you'll get a pre-approval letter that you can show your mortgage broker, and then you can get started on a pre-approval for a mortgage. Then once you have the amount that you're looking for, you found a house, you've put in a purchase and sale agreement and it's been accepted, you're pretty much ready and you're just looking for financing, you have all those other conditions, then you would go back to the province and say, okay, this is all my documents, this is everything that I have for this is the house I'm buying, and then they'll work to make that kind of started, and they'll work with your lawyer, they'll work with your mortgage agent to make sure that it's all kind of done in a seamless process. So it's really easy for you. It's an interest-based loan of 5% per annum over a 10-year term. So monthly payments are pretty low, but it's also best sometimes to, try to pay off that as fast as you can rather than having a 10-year loan. But you can opt out of your payments for the first year. So that's a nice little thing while you get settled.
And what's the price cap on a down payment assistance program at home?
It's $350,000 right now. I can expect that to go up, I would say.
Just like everything else. So what type of property would best qualify for the down payment assistance program?
So they can only allow properties that are owner-occupied single-family dwellings. So any recreation properties, rental properties, seasonal properties do not apply, and also anything on rented land does not apply either. So
that's important.
It's basically in that slim criteria that you're kind of fixed to.
Okay. Yeah, single-family owner-occupied dwelling on a freehold title.
Yeah.
Okay, awesome. So who should apply?
Well, we say everyone should apply, basically. The province, they put this program in place, and there's a lot of leeway, there's a lot of leniency. We've had clients who, on paper, did not meet the criteria, who applied, and they still got the loan anyway. So I basically would say to clients that everyone should try. The actual official criteria basically is you have to be a Canadian citizen, of course, island resident. Your household income needs to be less than $95,000 per annum, but again, there's leeway on these things. And you need to be a first-time home buyer, of course, right? So being a first-time home buyer, a lot of people think that means you've never owned a house before in your entire life, and that's not entirely true. The technical term for the first-time home buyer for us on PEI would be basically that you have not owned a home in the last 4 years, that maybe you've been in a situation where you've been renting and you sold your home, and then you've been in a renting situation, and then now you're in a situation where you're looking to buy again. Well, you could qualify to be a first-time home buyer. It's not just you purchased one home before and sold it, and now you
one and done. Okay, exactly. Perfect.
And if you've had a breakdown of marriage or common law, you can also apply for the down payment assistance.
Yeah, you qualify as first-time home buyer again.
Yeah.
Oh, okay, awesome.
Yeah.
So I would definitely say, make sure you're checking with your mortgage agent, your mortgage professional. Ask them, do I qualify as a first-time home buyer? Because you never know. And when it comes to down payment assistance, like I said, I tell everyone, apply, even if you think you won't get it.
Every bit helps.
The worst they can do is say no.
Yeah. And of course, if you have the down payment saved, it's better to use, that for closing costs, of course. But if you're pretty near that limit of the total debt service, then it's best to use your down payment that you have, right?
Yeah. Okay, everyone's favorite topic. Let's talk about interest rates. Obviously, they have just risen again this week. So how have the recent rate increases impacted mortgage financing?
Tremendously.
Yes. Yes.
Obviously, throughout all of this year, we have seen numerous rate increases.
Yeah.
interest rates, they are kind of like the brakes on the car of the economy. More cash in the economy means more gas, but obviously we've had high inflation due to the pandemic and all these different things.
Everything's costing more.
Everything's costing more. So the way that, the central banking system kind of regulates that is by the rise in interest rates, which kind of ceases the flow of cash into the economy, which of course then, causes interest rates
hits
to go
the brakes.
up and hits the brakes, right? Yeah.
And it's changed the way that we've had to approach mortgages. I mean, in the beginning of this year, we were able to suggest 5-year fixed because they were still in the 4%, and that was doable for quite many people. But now we're kind of gearing toward, fixed rates for a shorter period of time, like 2 or 3 years, or suggesting a variable rate, which you're going to have a squeeze for a little while, and then once interest rates come down, so will your mortgage payment. So these are the different things that we're kind of adjusting our view now to make sure that our clients are taken care of.
Yeah, it really depends on the client too, right? It depends on everybody's circumstance.
What their goals are long term.
Exactly. Like some clients, they want the comfort of a fixed rate. They want the comfort of knowing what their payments are. And they don't really care so much about, the cost of breaking down the line. But like Hannah was saying, in those kinds of situations, we are usually recommending shorter terms at this point, just because, we do think that rates are going to probably stay the way they are or increase for at least the next little while. But hopefully...
So what's a little while? Are we talking like 12 to 18 months?
Yeah, I'm not an economist. I'm not
there's no crystal ball. I completely know.
So I definitely can't say for sure with any certainty what we're looking at, but I would say at least a couple of years, at least.
I think a good sign is that the Fed and the Bank of Canada are starting to do smaller increases. So I remember I called the full 100 basis point jump there that we had recently, and I think that it's a good sign that we're starting to see the 50 basis points hikes, but I don't think I think that'll make it longer term. So I think we'll see higher interest rates probably until the end of 2023, I'd say. Not saying that they're going to keep going up, but they might just stagnate and go down 25 basis points maybe.
Yeah, we are fortunately, obviously as the financial advisors, we're looking at the economy, we're looking at, the consumer price index and all these different factors that display the rate of inflation in the economies around the world and in Canada especially. We are seeing that inflation is starting to stagnate a little bit. It's starting to slow down.
Thankfully,
Thankfully, right?
Yeah.
That's the main goal of what they're doing, right? And it is starting to happen, but it doesn't seem like it's happening fast enough,
No, and it's really not looking like it's going to on the real estate side of things. We're not forecasting any relief from the negative impacts on the market that we've seen recently until kind of 2024, which isn't necessarily the worst thing in the world because property values have risen really well in the Charlottetown area, and we're seeing, Sherwood School is going to be finished at that time. The PEI Medical Center is going to be finished 2024. So we do have a lot of growth in Charlottetown that kind of coming up out of that dip. I think we're going to see homeowners get some relief in 2024, both through interest rates and property values are going to kind of show the strength that they have in recent years. We're seeing a dip right now for sure.
I do think so, and I think right now it's kind of stagnating, and after the crazy market that we had last year on PEI.
Yes.
I think
red hot.
I think this next year there's quite a bit of forecasting that housing prices are going to drop on PEI and in Atlantic Canada, but I think we will see that more or less happen in the country rather than Charlottetown, because Charlottetown's always going to be...
Well, the demand is always there.
It's always there. And with these new amenities, it's definitely going to boost those different things. Everybody wants to be close to a library and things like that.
This is a beautiful new Charlottetown Library and Learning Center that we're filming from. Another great addition to Charlottetown in recent years. And then when people are ready to refinance or their terms are up, then there are some great options available with hopefully less scary interest rates. So stuff to look forward to. Bit of a rough year ahead, I think, all around your field and mine.
100%.
Yeah. And I mean, I think, when it comes to the current markets, there are some clients, like I said, who want that fixed rate. They want they know what their monthly payment
security,
is. Security, right? But we kind of have been talking to clients a lot more about adjustable rates, right? Because like Hannah was saying earlier, there's a bit of a short squeeze happening on the adjustable side, but within the next couple of years, if you want to lock in that 5-year rate, you're probably going to be locked in at a higher rate throughout that term, but if you go for the adjustable rate right now, then we think there's a short squeeze, but near the end of it, you're probably going to be coming down.
Better off, yeah.
Better off, yeah. So it really just depends on the client and their situation.
Yes,
and their
exactly.
personal preference.
What's good for one isn't good for all. Go ahead.
No, sorry. And a lot of people are getting squeezed by household consumer debt as well that we're seeing.
Yes.
And that's really affecting a lot of people when they go to refinance. They don't have, they're looking to get that equity out of their home to pay off that debt that they're paying, double digits in interest for, when in reality a HELOC right now still under 7%, in the mid 6%. So we're looking at that as a solution for these people who are feeling that tight squeeze of inflation, where everything is costing more expensive, everything is more expensive, and their household budgets are being squeezed like they. You can't have the same budget as you had last year, this year.
Yeah.
No. And let's talk about changes that are coming to the credit card minimum payment system.
Yeah, no, it's going to be, it's very difficult for people to make their minimum payments right now, and I think it's concerning to see this, because we talk about this all the time, how the credit system right now is really affecting the youth.
Yeah, 2% on your minimum payment increases. That's going to impact your monthly budgets. That's going to impact what you qualify for on a loan. Yeah, it's a lot.
Yeah, it's best to stay as debt-free as you can right now.
Especially now, yeah.
It's very important.
Debt has been very cheap for very long, and I think we're paying the price for that now.
A lot of people are paying the price for that, for sure. And to be fair, there have been outside influences in the country who have kind of pushed debt on people and said debt was good, and debt has its purpose, but of course now we're seeing the cost,
the downside of that. Yeah,
exactly. And like Hannah was saying, it's adversely affecting the young people in this country, for sure, especially PEI. I find young people are having such a hard time getting established and getting into the market, into a first home, and we've spent a lot of time over the last year working with a lot of young people who are trying to get into their first home, trying to get into the market, and they're struggling with whether it be student loan debt or credit card debt or whatever from the pandemic. It's a tough time for everyone.
It is. Prices were kind of high for a while there, which was tough for buyers, but when interest rates were low, they kind of combat each other, and it was still somewhat affordable to get into the market. Now we're still seeing those high prices from sellers that have had great years. We've been in a seller's market here in Prince Edward Island for a few years now. So we have sellers that still want those high prices, and we have buyers that have to be very, very careful with the cost of borrowing money right now. So it's a tough market for sure.
Yeah,
it is.
Absolutely.
It is.
So with the market conditions that we're seeing and the interest rate financing conditions that we're seeing, I think in my experience, lenders have become a lot more picky, for lack of a better word, on the kinds of properties that they're willing to finance. Can you guys touch on this at all?
For sure. We can definitely touch on that. We would agree, 100%. A lot of people who are coming in to purchase new property from us, to finance new property, whether it be second home buyers or whatever it is, people who have experienced the mortgage process before, they're very surprised at the new type of stringent underwriting that the lenders are asking for. And the reason why, of course, is that you've got a variety of factors. You've got rising interest rates, you've got increased cost of living, which means that the risk of default is higher, which means that there's more risk of foreclosure. So there's greater risks to the lender now. And I find that, in our business, we've definitely seen that they are becoming more stringent, and they are not as willing to finance, maybe rural properties or mini homes or rented land properties or what have you, right? And so that's putting more pressure on, especially first-time home buyers and young people, because those are the
kinds of properties that they typically buy.
Exactly, right? So, we have a heck of a time trying to finance some of these rural properties and some of these mini homes, and it's because, like I said, the underwriting on the back end for the lender, it's greater risk, so they're finding it more and more difficult to take the risk on those kinds of properties, right? They want to keep things more central, closer to transit,
healthcare, education,
property that are more than likely going to maintain their value over time.
Yes,
right?
and to be rentable, I think, or saleable is really important to lenders
Yeah.
now in a way that it maybe wasn't over the last few
Maybe even
years.
10 years ago, right?
Yeah.
Or 5 years ago.
Yeah, and holding their current value. Now that there's a big bump, I mean,
Yeah.
Yeah,
down east and other places, we're seeing mini homes go for $300,000, and
Yeah.
even it's just crazy seeing the price of bungalows, and
Yeah.
like it's insanity to see
Yeah.
the difference, and
Yeah.
so those are definitely harder to finance now because people who would usually be in that market of under 200,000 are just over. They can't find anything anymore. Even
and when they do find it, they can't finance it. So it's been a struggle, yeah.
Yeah, definitely.
It's very frustrating for young people. It is. I see it every day.
Yeah.
Exactly like you said, these first-time home buyers, they're in the market for these mini homes, for these, under 200,000 property. And most of the times when we find them, we can't finance them because of
Yeah.
the stringent underwriting.
Yeah, it's a struggle.
It's a struggle.
So as we've discussed, this is a difficult and potentially stressful time for people to buy a home. So how can they best prepare when they think they're ready to purchase?
It's a good question. I would say the first thing you should do is take an opportunity to learn about the situation, to, educate yourself on how credit works, what interest rates are, how they affect your monthly budget.
Yeah.
Because we say amongst ourselves all the time that they don't really teach these things in school. And
true.
so, if you're fresh out of school and just getting into a career and you're at a position where, you're ready to make your first purchase, a lot of the people we find who are first-time home buyers, they don't really understand how many of these things work, right? And so I would say the first thing you should do is to sit down with a financial advisor, a mortgage agent, or a realtor, all these different professionals in the industry, to make sure that you understand, again, like I said, how credit works, how different things affect your credit score, how credit ratios work,
How to budget.
how to budget for
Yeah.
this purchase, right? All these different factors that you don't really learn in the education system. Learn these things and really understand how they work, and really just
And another big thing is keeping your debt low. So, I mean, you turn 18, you have the access to the credit cards,
first
and
time,
the
Yes.
student loans. I totally get, because you have to kind of build yourself up.
Yeah.
But once you get established in a career, it's really important to keep your debt low.
Yeah.
I mean, do you really need to finance your car, or can you, it's a really difficult time for people because, I mean, there's so little cash flow going around, but, it's really important to keep as little in debt as you can. So that means keeping your credit cards low, making sure that you're making your payments.
Yep.
Those are really big things, because once we go into a mortgage application and we look and you have too much debt, usually with that on top of the mortgage, you're in too much debt to
Yeah, that's a
carry it.
really hard
That's-
hole to dig yourself out of. And especially with these rising interest rates that we just talked about, it's more expensive now to carry a balance. So
it just pushes the margins even more, right? I mean, because
Yeah.
you think about it, if you're financing a vehicle, well, the interest rates on that are usually locked in, but maybe if you're just starting to finance a vehicle, well, the interest rates on that are higher. And then if you're going to get a mortgage and you've got student loans, you've got all credit card debt, you've got all these different debts, it can add up quick, right? And to the lenders out there who are offering mortgage financing, there are certain ratios of debt that they have to sit within in order for the mortgage to be approved. And, we can work our best on our end to try to make that work, but at the end of the day, I completely agree with what Hannah said. The debts need to be kept low as possible.
So in layman's terms, like what percentage of your income should be debt?
That's a difficult question, because it depends on the size of the mortgage that you're looking to get,
Yeah.
right? Because we do have to say under the total debt service and the gross debt service, it has to be under 39 and 44%. So the gross is all of your debt plus the mortgage plus everything encompassed. The TDS, which is the total debt service, that is your mortgage. So that includes your property taxes, your heating, your mortgage insurance if it's under 5% down. Under 20% down.
Under 20%.
So those are things that are all included, including your mortgage payments. So those are all things that are included in that total debt service, and that has to stay under a certain amount.
Yeah.
So it's really important to keep as little of your income going toward debt payments, and maybe for a little while before you buy a house, make extra payments that go toward your principal.
Yeah, budget towards more debt payments.
Yeah.
Paying down the debts.
Yep, exactly. That's really important to do, because any extra payments usually go toward your principal. So that will make you pay less interest, takes time off of your loan or line of credit. It's really important to do that.
Yeah.
Helps your cash flow.
Yeah.
Right? Because you're getting charged less in interest as well. So that helps you on a month to month.
100%.
Yeah.
So that's the biggest thing, is to just keep your debt low.
Yeah.
Especially in the type of environment we're in now.
Yeah.
Yeah, because we see people with these, new cars and the big trucks and, all these different things, and they're so shocked that can affect how much you can get in a mortgage. I believe $1,000 in debt actually changes $30,000 of a mortgage that you can get.
Oh, wow.
Usually. So that's something that you really have to watch out for. Because if you're getting a $30,000 car,
that's a big difference.
That's
big difference.
Big difference. Yeah. So that's one thing that you really got to watch out for.
And one thing that I do personally, and I'd love to hear about your opinion on this, is to monitor your credit score.
Yeah, there's some ways that you can do it for free. If there's some credit card companies that will automatically track it for you, like Credit Karma. Sometimes those don't usually catch everything.
Yeah, they don't update fully all the time.
No.
Yeah.
So it's good if you are really looking to buy a house and you're really serious about it. Subscribing to Equifax, and then you pay a monthly fee and it updates every week. That is the best way that you're going to see it. And if you do pay off some debt and you notice that it's not on your credit score, or say you had something in collections and you paid it off, it's not on your credit, it's still on your credit report, then you need to let them know.
Sometimes they don't get reported to the bureau right away, and then that's affecting your ability to qualify.
Of course,
Something you need to be on top of, for sure. And another thing too, I mean, with Equifax, the Canadian government does require the credit agencies to issue one free report per person per year. So if it's a situation where you don't want to budget to look at your credit every month, at the very least you can reach out to them by, I think, letter usually is what they require, and request your credit report, and they are required to give you one free one per year.
Perfect. So for people that are potentially evaluating their ability to purchase a home, is there a kind of a layman's term credit score that you would suggest? I know it used to be 680 for the longest time. Is that kind of still the case?
It does depend on the product that you're looking for, because I mean, some lenders will only do 700. Some will allow for lower than 580. But it really depends when you're buying, where you're buying as well. Because I mean, if you're going with an alternative lender, you can have really bad credit. But it kind of depends when you're buying. You're going to pay a higher interest rate. So those are things that you need to think about, of course. But when it comes to going with an A lender, is what we call them. A prime lender, usually it has to be 580 at least, but it's always good to have it.
And there's options, like with mortgage agents like us, there's options that the big banks don't have, right? We have access to many lenders in our network, and all the other mortgage agents have access to lenders as well, that if your credit situation is such that maybe income wise you're in a good position to buy a home, but your credit suffered a little bit, there could be options available
to mitigate that. That would be great.
Whether it be alternative lenders or B lenders, private lenders, all sorts of different options. So definitely check in with your mortgage agent.
All right, guys, so a last question, and this is a question that I get a fair amount. So for those buyers who are successful in their pre-approval and they are under contract with a home, one of the questions that they get before closing from their bank is typically around mortgage insurance. Should I get mortgage insurance? Should I use the bank's mortgage insurance? What do you guys think?
No.
Wait, so no to which part?
No, okay, so let me clarify. So there's a couple of things that happen when it comes to the insurances with the mortgage. So I think there's a differentiation between mortgage insurance and the mortgage life insurance portion, right? So in Canada, if you are putting less than 20% down on a property as a down payment, the lender will want mortgage insurance on the property, right? Or on the loan, rather. So the mortgage insurance basically is creditor protection that protects the lender against default, right? Because if you're putting less than 20% down, there's an increased risk.
You're higher risk.
You're higher risk, right? So the lender can require you to pay for mortgage insurance to protect them from default, which is, just whatever, it's through CMHC or Genworth or whatever.
Yeah.
And it's non-negotiable.
And it's non-negotiable. It has to be paid. If you're doing less than 20%, you have to pay it. I'm sorry. The other kind of situation that you have to deal with is mortgage life insurance, right? Because a lot of people, obviously with mortgages, there's a lot of things that people don't really think about. One of those things is life insurance, because obviously you've got this huge financial responsibility. It's an enormous, debt that you're taking on. If you've got a family, if you've got a spouse or whatever, there's huge risks to them if something were to happen to you yesterday. We always say yesterday, never tomorrow.
Yeah.
We don't know what tomorrow brings.
Yeah,
right?
exactly. You don't want to jinx anyone.
Don't want to jinx anything, so we say yesterday. So life insurance is something that you need to consider when you're doing your mortgage process, because obviously you want to make sure that you're protected, your family is protected, and that if something were to happen yesterday, that it's a difficult conversation to have, but it's a conversation that needs to happen. And most of the banks, most of the institutions, they will sell mortgage life insurance in the form of like MPP, mortgage protection plan, and this is different from traditional life insurance in the sense that underwriting is done at the time of death. That's the primary difference between the two of them. Whereas with traditional life insurance, underwriting is done at the time of application, right? So when you're going through this process, the institution will probably offer you something like a mortgage protection plan or what have you, in order to, quite frankly, protect themselves. It's another form of creditor protection because the beneficiary is always the lender.
Yeah.
Right? So if something were to happen to the borrower yesterday and they had this in place, the mortgage would be paid off, but there are certain benefits to having traditional life insurance over mortgage life insurance.
Yeah.
And a lot of the banks basically say, here's what your mortgage insurance is going to be. There you go. Like, it's non-negotiable, and it's always negotiable. The other mortgage insurance, of course, isn't, but mortgage life insurance is. And I find it's really important, and it's an added value of us being financial advisors, is we can offer life insurance to people. We can say, okay, this would be your premium with, the lender's insurance, where it's pretty much the same monthly, if not higher. Underwriting is not done.
Yeah, there's no guarantee that in the event of an emergency, they're going to pay out.
They ask about 5 to 6 questions based on your health, and if you answer no to all those questions, then you get it. But if there's something that happens to you, and it doesn't meet that criteria, and it's underrated at the time of death,
tough luck.
Yeah,
it's so funny, right? Because people, we kind of bring this up to them when we talk about it. It's like, basically, you're going to pay this payment going forward, and if something were to happen to you, when you need the money, that's when they're going to decide if they want to give it to you or not.
Yeah.
And people, their eyes widen, and they're like, well, can they do that? It's like, well, yeah, they can because you agreed to it, right? Definitely you want to look into traditional life insurance because, like I said, in most cases the premiums are less than the creditor life insurance. In most cases, you're locking it in for the entire amortization period, so 25 years. So your premium will stay the same every year going forward. If you are doing it through like a mortgage protection plan through the bank or something, every 5 years or 2 years or 3 years when you come to renew your mortgage, the insurance portion renews as well, which means that you're older, so your premiums are higher. You can lock in that price for 25 years. The other thing that a lot of people don't consider with it is, let's say hypothetically you purchase a $350,000 home, and so you buy $350,000 worth of life insurance, right? If something were to happen to you and there was only $100,000 left owing on the traditional life insurance, then basically what would happen is that money, the $350,000 that you've been paying for, would flow to your beneficiary. So it would be like a spouse or a child or somebody, your estate, basically, right? Another option, and that money would flow to the people who could best decide what they want to do with it, whether they want to pay off the mortgage or whether they want to move the money elsewhere. It's the choice of the beneficiary. Whereas with the creditor life insurance, basically the creditor is the beneficiary. So that flows to them. Big difference. And the other thing too, if you are paying for $300,000 worth of coverage through the mortgage life insurance, and your balance is only $100,000 at the time of death, even if they decide to give it to you, they're only paying your mortgage off. You've been paying for 3, but you're only getting 1. Right? So that disparity and the difference there, that's money that's being taken away from your family. Right? So, we push this to clients all the time, at the end of the day, it's their choice. If they want to go with the creditor mortgage, if they want to go with traditional life, it's the choice of the individual family, but they should at least consider the additional value that traditional life insurance gives over a mortgage life insurance.
And a lot of people say, I have bad health and, I can say no to all these questions, but I wouldn't qualify for traditional insurance. We have access life policies where you can get, guaranteed issued policies.
Simplified issue.
Yeah, where you can qualify even if you do have health issues.
Yeah.
And one big thing that we see often is people saying that their work insurance, their work life insurance will cover their mortgage. I have life insurance through work. It's no big deal.
How much life insurance through work?
Yeah, and what are the conditions?
And what are the conditions?
Is it 2 times your salary? Well, if you leave your job and, say you work at that company for 10 years, you start at 20 and then you get to 30 and you decide, okay, I'm going to move companies and that company doesn't have as big of life insurance, you're going to pay more for insurance down the road. It's never guaranteed that you're going to be on that plan. So it's best to lock in when you're young, especially when you're taking on new debt, say, a car payment, a house, you're having kids, you have a spouse. Yeah. It's so important, and we see it all the time.
All the time. It's the funniest thing, especially with younger people, because they don't really think about these things.
Yeah,
people, they never think, right? But it's so funny because when you think about it, younger people will say, oh, well, why do I need life insurance? I'm young, I'm healthy. And it's like, so you want to get it
later
when you're old and unhealthy, and it's either
and you're paying more.
More. It's either unaffordable or they just won't give it to you. Like it's an oxymoron. It is, right? The best time to do it is when you're young and healthy, because that's when it's cheap. That's when it's affordable, right?
Yeah.
Especially if you're we're talking about first-time home buyers and younger people getting into the market. Now is the time to put these things in place rather than later. We could get into the differences between the insurance on a 20-year-old versus a 30-year-old versus a 40-year-old. But at the end of the day, the older you get, the more expensive your coverage is, and the less likelihood that you're going to be able to get affordable coverage.
Yeah. And even in my experience with clients, I've kind of noticed that the quotes that they're getting from these banks, if they were to pay the same monthly payment to a traditional life insurance policy, way more coverage. Way more coverage for the same money.
And it's once it's issued, you're guaranteed unless something does happen within that time frame.
Underwriting is done at the time of application, right?
Yeah.
So and then basically once it's done after the time of application, the only time you can really not have it paid out is if there's an instance of fraud, right?
Yeah.
If somebody lied on the application or something. But
or something happens within 2 years.
Within the 2 years, yeah, exactly, right? So no, I think that people need to think about that for sure. And the other value of going to an insurance advisor as well is that mortgages, of course, are a big responsibility to cover, but it might not be the only responsibility, right?
Yeah.
If you have children, if you have dependents, that's something to consider, right? You want to make sure there's a estate left behind for them if there's other debts that need to be taken care of, right? Financial advisors, insurance advisors, we are able to kind of look at your whole situation and determine what is the amount of risk here, right?
Yeah.
And the mortgage is included in that.
Yeah, it's usually a better product that's a better fit for that individual for better money, in my experience. Yeah.
I don't think we've ever done a lender policy so far since we started. We always present it because we're required to, of course, but a lot of the time the client opts to go the other direction.
Well, they see the value, in a different option.
And we talk about the value of both of them, of course, but it's really important that people are more aware of what it means, and if they are getting their mortgage from a bank, that they don't sign that dotted line. They actually look at their options rather than go with the creditor insurance.
To be fair, the big banks, they are very good at putting this in front of you and making it seem like the mortgage hangs on you signing this additional creditor insurance. In reality, that's not the truth. There are many options available to you, and you should look at all of your options and, like I said, not just sign on the dotted line.
Yeah, shop around, shop your rate, shop your insurance, everything you can. Yep.
100%.
So I'd like to thank Nick and Hannah for chatting with me today, and I will shout out the new Charlottetown Library and Learning Center one more time. This is a beautiful, great space, guys, so come down and check it out. If you want to find me on social media for any questions, you can do so. You can find me at PEI Pro Realtor on Facebook, LinkedIn, Instagram.
And our business, we are Virtue Life Financial, based out of Stratford here in PEI. You can find us on virtuelife.ca, and you can also find Hannah at hannahmartens.ca, and myself at nicholascadet.ca.
Take care, guys. Have a good day.
Yes.
Bye. Thank you.